Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help POA students like you ace their exams. Today we have got a question from a past exam. So this is question number 2 from 2023 paper 2 exam. In this question, we will understand the 3 causes of depreciation and why a business may prefer the straight line method over the reducing balance method. Lastly, we will understand all the journal entries that are relevant to the sale of a non-current asset. You can see the question on the left-hand side of your screen, and on the right-hand side, we have got all the workings which I'll explain step by step. With that being said, let's begin. Lai runs a marketing business with a financial year end of 30 September. This means we're working with a business where the financial year starts in 1 October of a given year and ends on 30 September of the following or next year. The business owns office equipment and uses the straight line method of depreciation. First part of the question is to state 3 causes of depreciation. The 3 causes of depreciation are wear and tear, and then obsolescence, which is also referring to outdated. This is mainly possible with technological items. And lastly, passage of time that has expired. So as you use the asset in your business for the purpose of generating revenue, over time, it loses its economic value. And therefore, the passage of time also contributes to the cause of depreciation. Part B. State why business might apply the straight line method rather than the reducing balance method to depreciate its office equipment. Now, the straight line method is very easy to calculate and use, because we calculate the depreciation by simply multiplying any given percentage we have got with the original cost. Or if you are using the other method of calculating the straight line method of depreciation, you would start with the original cost and then you subtract any scrap value, and then you would divide this with the useful life. But when it comes to the reducing balance method, we would only use it if we are using an asset where more economic benefits are extracted in the earlier years of usage. This is possible with technological items which go through obsolescence very quickly. So in the earlier years, you're able to extract more output by utilizing these assets in your business. So if you had got a question where you had asked to provide valid reasons for why a business might use the reducing balance method instead of the straight line method, you could choose this explanation where the business prefers to use this asset and extract more economic output in the earlier years for the purpose of generating revenue. Okay? All right, so let's now understand the journal entries relevant to the sale of the non-current asset. Lai's business had purchased printing equipment on 1 October 2021 with a cost of $8,200. This equipment had an estimated useful life of 4 years and an estimated scrap value of $200 at the end of its useful life. The business does not charge depreciation in the year of sale. On 1 June 2023, Lai's business sold the printing equipment for $5,600 cash, and we are required to prepare all the journal entries to record the sale of the printing equipment on 1 June 2023 and calculate any gain or loss on this sale. All right, so in this case, the straight line method formula for depreciation is the difference between the cost and the scrap value, which is the numerator here. Then you divide with the useful life for number of years. The original cost of the purchase price given in the question is $8,200, which is what we have used in the formula here. And then we subtracted $200 of scrap value, and then we divided the entire numerator with 4 years. Now, what do we understand by scrap value? The scrap value simply means the possible price that you are able to sell your asset after its useful life is over. So let's say after 4 years have passed, this equipment can be sold for a maximum of $200. So the depreciation using this formula for this printing equipment is $2,000 per year. So based on the question and all the information we are given, we know the asset was bought on 1 October 2021, which means the first year of usage for this equipment would be from 1 October 2021 until the end of 30 September 2022. And in this first year of usage, the depreciation expense incurred for using this equipment is $2,000 based on our calculations which we have done a while ago. Year 2 would start on 1 October 2022 and end on 31 May 2023. This is because we have sold this asset on 1 June 2023, all right, which the question explicitly mentions here. And the question also mentions that the business does not charge any depreciation in the year of sale, which means in year 2, which is the year of sale, we don't have any depreciation expense to be calculated, all right? So the only depreciation that we have got so far for this equipment until the day of sale is the $2,000 that we had derived for year 1. Now, let's find the net book value during disposal or just before the sale of this asset. The net book value at any given point in time can be calculated as the difference between the original cost and the accumulated depreciation. The original cost of the purchase price for this equipment is $8,200 and the accumulated depreciation, which stands for the total depreciation, is $2,000, which is basically the depreciation we have calculated for year 1. And we know in year 2, which is a year of sale, we do not have any depreciation based on the business policy. So on that basis, the net book value is $6,200. Now the amount we have received by selling this asset, which is also referred to as the disposal proceeds, is $5,600. As you can see, the asset had more value remaining, which is $6,200, but we ended up selling it for less than its economic value at $5,600, which means we definitely sold this asset at a loss, and the amount of loss can be calculated by finding the difference between the net book value and the disposal proceeds, which is $6,200 minus $5,600, and that gives us a loss on disposal of $600. This is also answering our part D directly, okay? All right, so now let's look into the journal entries for how we can record the sale of a non-current asset. So when it comes to recording the journal entries for the sale of a non-current asset, we would want to do it in multiple steps. First, we would want to remove the original cost of the asset that we have sold, all right? So equipment by default, before it was sold, it was a non-current asset which was debited in the business financial statements or in the business books, right? Because assets went up. But now that we have sold this equipment, the cost of this equipment should no longer remain in the business financial statements moving forward. Therefore, we are to reduce this value of equipment, the cost of the equipment. And here we are reducing the assets. Therefore, when equipment goes down in value, assets are going down in value. And when assets go down in value, we credit them. So we'll credit equipment by $8,200. So we are removing the original cost of the asset from the total non-current assets that we will be reporting in the financial statements, okay? And the reason we did this is because we have sold this. That's why the corresponding debit entry is to debit the sale of non-current asset accounts. I've written NCA in short. You could write sale of non-current asset in full by $8,200. Next, we would want to remove the accumulated depreciation for this asset sold, okay? We understand that accumulated depreciation in itself is a contra asset account. What do we understand by a contra asset account? A contra asset account is an account which we prepare to record all the reduction for a relevant asset account. The relevant asset account in this case is the equipment. As the equipment gets used within the business for the purpose of generating revenue through many years, what happens is that the equipment goes through wear and tear, loses its value, passage of time, and obsolescence, the things that we've discussed earlier today. So all this reduction in value for this equipment is stored in a separate account, which is known as the accumulated depreciation of equipment account. And by default, it's a contra asset account, which means it is always credited when it increases. Now that we have sold our equipment, we do not report it any longer in our business financial statements. Therefore, we would reduce this accumulated depreciation of equipment, and to reduce that, we will debit it, because when accumulated depreciation goes down, we debit it. So we debit accumulated depreciation of equipment by $2,000 to reflect this decrease, okay? And at the same time, we are doing this because we have sold this asset. That's why the corresponding credit entry is the sale of non-current asset account by $2,000. Again, make sure to write the full form in exam. Next, we want to record any proceeds from the sale or any amount we have received by selling the asset. We know we sold this asset for $5,600 cash, right? So because we have sold it for cash, it means our assets in the form of cash have gone up. And when assets go up, we debit it. So we are debiting cash in hand by $5,600, okay? And the corresponding credit entry here is obvious to the sale of non-current asset account by $5,600. If you had sold this equipment for $5,600 check instead of cash, then you would have debited the cash in a cash at bank account, all right? So make sure you understand the differences and you're aware in exam whether it's cash in hand or cash at bank. Lastly, we want to record the loss from the sale of the non-current asset. It's not really needed, but it's better for you to use it because you are no longer required to prepare the ledger account for sale of non-current asset. But if you were preparing it, you would have recorded the loss as well. Now, the loss of $600, which we have calculated earlier as the difference between the net book value and the disposal proceeds, which is $6,200 in net book value minus $5,600 in disposal proceeds, and that was $600. So loss in itself is an expense, and all expenses by default are debited. So that is why we are debiting the loss on sale of non-current asset account by $600. And we are only doing it because we have sold this asset. That's why the corresponding credit entry is the sale of non-current asset account, which shows an amount of $600. So that's it for the solution for this question. Make sure to subscribe to this channel and also let me know if you need help with any other topics. You can post them down in the comments below. I'll be uploading more videos from past exams on a daily basis. Also, if you're looking for coaching or tutoring sessions, make sure to check the link in the description. So the link is for a free Zoom call and we can discuss any requirements you have got up to the exam date so I can help you prepare and get an A1. So with that being said, I'll conclude today's lesson and I'll see you in the next one.